Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by managing director and investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm great, Ross. It's always good to be back. How are things with you?
Yeah, we're good. We're good. Off and running with a new year, and with that brings an opportunity to ask some of the big questions for a coming year and to reflect on past years. You wrote something today that I think is one of the big questions on my mind, on our clients' mind, which is, can U.S. exceptionalism continue? That is, U.S. stocks have outperformed by such a significant margin over the last several years and really over the last decade plus. What is driving that, and do you ultimately think it can continue into 2025 and the rest of the decade?
Yeah, no, it's a great question, and it's one that we constantly talk about with clients. I mean, at the end of the day, when you look at the call, I'll call it the Magnificent Seven, but you could say the top 10 stocks in the S&P 500. There's some of the fastest growing companies out there. When you look at what their growth rates are, they're expected to grow between 17 and 21% next year. That far exceeds the overall S&P 500, and it far exceeds any international index as well. So from my conversations with clients, they essentially tell you, okay, we have to own the largest companies within the US. They're the most innovative companies. And not to mention, they're actually a little less susceptible to changes in interest rates than other companies, and that's largely because they generate so much free cash flow. They're self-funding. They're not necessarily reliant on the capital markets, and they're just overall good companies. I mean, they're innovative. They are constantly moving to where the puck is going, rather than trying to follow other companies. So they're the most innovative companies out there. As far as if that's going to change anytime soon, it's really hard to it's hard to see that changing. If you think about what regions of the world where you would ultimately need to see that, Europe generally doesn't have a lot of these growth oriented innovative companies out there. You have ASML and AstraZeneca, which were really the two most innovative, and they're kind of in the same space that some of the large U.S. companies are in, whether it's healthcare or semiconductors. So they're sort of following in the footsteps. And then you got to think about internationally and Asia. It's really challenging to kind of want to say, okay, you're going to buy this Chinese company. If you look over the longer term, investing in China really hasn't been a big payoff for investors generally over the long term. Yeah, sure, there have been fits and starts with regards to trades, but it's not necessarily a long-term investment the way I kind of think about things.
Yeah, and if you think about it in terms of how you framed it at the beginning, right, which is U.S. companies and particularly the Magnificent Seven are just growing their earnings at a faster clip than most of the companies abroad, and that has driven a lot of that outperformance. We're sitting here on the cusp of another earnings season. Earnings growth is expected to be a bigger part of the total return story in 2025. How do you see earnings shaping up, and then how do you differentiate the growth story between the Magnificent Seven and call it the other 493?
Yeah, certainly. So, I'll start with kind of the fourth quarter. We're at the very beginning of the fourth quarter, and so far it's been outstanding. Frankly, we got 6 financial companies reported this morning. Every single one of them beat estimates. I think they're going to be a big component going forward when you think about the remaining 493. The fourth quarter alone, they're expected to be the second strongest group. The first strongest group is actually going to be the communications sector based on the current estimates. But the financials really have to have the ability to drive the index growth further, and especially under the incoming Trump administration. If deregulation is going to be a big story, that's going to play into the earnings growth that's expected for 2025. Right now, we stand at about 13% earnings growth next year. There's a lot of back and forth about whether or not that's achievable or not. Obviously, that's been above where the long-term growth rates have been for earnings going back to the 50s. And so, certainly there's some concerns from that end of things. But, there is a path ultimately to get to that level, and it's the financials contribute. It is we get an uptick in the healthcare sector, which we've actually started to see some turn more recently. And then the energy sector, which has actually come to life a little bit here as we've started the year. If you get a slightly higher oil prices, that increases the profitability. Deregulation story will also help the energy side of things as well. Just the fact that regulators will be, in these offices of these financial and energy companies less will ultimately benefit their bottom lines from a compliant cost standpoint. So that's, you could see a little bit of margin expansion there. But of course, the big thing that has to occur is that the large weights within the index have to keep continuing to hold their own, and that's the Nvidias of the world. And I see, from right now, we really, it's hard to see anything changing. The AI story is not one that's going to go away. Companies are constantly looking for ways to innovate, looking for new applications of AI. So the demand side of things is still there for AI overall.
Well, Ryan, that's a really great kind of summary as we head into this fourth quarter earnings season. I want to thank you so much for the time, and hopefully we'll get a chance to catch up with you again later in the year.
Absolutely. Sounds great.